Here we go. So we're going to talk about how to unlock more closings with the non-QM loans. These products, one point, was not the favorite in the market, was not used as they are today due to all the changes we're having, everything that's going on in the market, immigration, politics, in the world, financial, stock market, whatever you can say it, drove and has driven many changes in our market today. What does the word QM stand for? Qualified mortgage. So under, let's say, the government standpoint, okay, under Freddie Mac and Fannie Mae guidelines. Who is Freddie Mac, by the way? Who is Fannie Mae? The investors that provide all the money to the lenders, and the lenders are able to borrow to all the borrowers, okay? So under their guidelines, under their qualifying mortgage, what is a non-QM is programs that do not go by a qualified mortgage standard, do not verify income or credit or assets the way a qualified mortgage would do. Through a conventional, they are called non-QM. So these lenders, the private sector, let's say, has grown a lot, and the private investors, even Fannie and Freddie Mac is involved in a few things here and there, but let's say this is more the private investors, have found a way to lend to people. Now, why is this so important to know the difference? Because if you were around 2008 and you heard about the crisis, or you lived through the crisis, you would know that many of the rules that banking uses today were broken, were taken away, because they wanted to make lending easy. But guess what? 2008, 2009, huge crisis hit the market. And that's what shook up the whole real estate industry. It changed. And I remember going through that. I owned my first property 2007. So I did go through the 2008. I've been through all that. It was very bad. But that's a subject for another day. I'm just trying to get to a point where does non-QM tie in today? So it eases in to the market as you guys been seeing it. More and more now it's growing. Before, when you had an I-10 loan, they used to be like 45% down, 40% down to get a house. Almost, I mean, not there's not that many people that qualified to buy a house. And if you had someone at 50% down, they would rather pay cash for the house, kind of. So these non-QM loans, I-10 loans, for example, being under there, came in, easy in to the market, making terms easier. Because why? The non-QM sector, these lenders are realizing that these people pay their mortgage. These people don't foreclose that much, and their foreclosure ratings are not as high as an FHA borrower conventional. So it's winning a lot of grounds. So that's what we're going to focus on today. I'm always going to compare FHA conventional back and forth to help you guys understand, why is it possible to still close a loan, even when someone doesn't have a tax return, for example. So let's say here, when traditional financing says no, we say, let's find a way. And for FG Mortgage, for my career, the last 20 years, that's been the same. If somebody says no to, I'll find a way to get it done. Because with all the products out today, it's almost impossible not to own a home. Everyone can own a home if they're willing to work the information, prepare, and get themselves ready to buy a house. Okay? So going to the next slide here, this is our team. You guys probably met them in person. If not, you will at our events. We're going to be planning more events, especially next year, which are going to be going live. I love to meet real estate agents live. But our team is so important in all these events we do and all the loans we do, because they're the ones that move all the paperwork, all the PDF documents, everything that has to go through underwriting processing. So our team is dedicated to make your life, the realtor. Let me get one more in here. Here we go. To make your life a lot easier. Okay. As you guys know, you probably heard, it takes a village to close loans here. It's not just a one-person job. Not even if you tried hard enough. It really takes a lot of people to make it work. Remember, Zuleika, Thais, any communications, just go to chat here because I do not have my WhatsApp open, just so it won't keep me distracted, okay? But anyways, looking into all the programs and all the paperwork we have to go through and different documents, our team is specialized and trained to guide through the process. It's actually a little more difficult to do a non-QM loan as far as the processing side than it is to do a conventional FHA loan. Although FHA loans also take a lot of docs, but non-QM underwriters are a little more tight with the guidelines. So keep that in mind, that sometimes you're going to see on the list of conditions things that require a little different than what you're normal to see. But here's the good news. The loans close, and they can close from 30 to 45 days, 60 days, maybe a little less if we're really prepared. We just had one that was a record for non-QM. I think JP did it in, it was about, I think it was 10 days, I would say, maybe a little less. 10 to 11 days, he got the loan done. That was our record for non-QM. Obviously, it was transferred from another loan, from another lender, and we had to restructure it real quick. But extremely hard to close them quick, but they can still do it in 30 to 45 days. We just got to make sure which is the lender we're using, the program we're using to qualify. So, what is a non-QM loan? A non-QM loan is a non-qualified mortgage, as I said, is a type of home loan that doesn't meet the strict rules by Consumer Financial Protection Bureau. Okay? If you guys look that up, you're going to see how they have guidelines and rules that all the loan officers have to follow, especially the real estate agents have to follow with the real estate side. Same thing with the mortgage guys, right? We have to make sure we follow that. So non-QM kind of doesn't meet those strict lines, and they bend it a little bit, and that's why it's possible to close a client without using a QM loan. You do a non-QM loan. So instead of the following rigid traditional rules like W-2s, strict debt to income, remember the 45, 50% ratios, also a little different. Caps or perfect credit. Non-QM loan gives us lenders flexibility to, I got more people here. Let me get everybody in. Welcome everybody that's coming in. We already started, so I'm just explaining what a non-QM is, but welcome. So basically, on an FHA loan, conventional loan, we'll say, hey, you got to go file tax returns. You got to give me a W-2s. With the non-QM loans, that's not a requirement. It's totally different. So it's so important to understand that even someone that never filed a tax return, even someone that doesn't deposit their money in their bank statements, in their bank account, and they don't have bank statements, even them can finance a home today. That's how non-QM has the power to do. That's how powerful it is, okay? Let me just explain a little more, okay? Self-employed borrowers, okay? Sometimes you have clients, and it calls us all the time, like, oh, I tried this lender, I tried to go with them, and I couldn't close. A realtor will call me, hey, Felipe, I'm having trouble. They're denying my client. Usually, 95%, I'm going to look into the situation. It's a non-conventional product. It's not an FHA product. It'll be a non-QM. And most of the time, they're self-employed borrowers. Why? You guys got to understand that. When someone's W-2 earner, works for a company, and someone's self-employed, the incomes are read differently. The incomes are documented differently. Meaning, someone that works with a W-2, their pay is right there. You get their pay stub, it's all listed. Gross, deductions, their net. But knowing that we go by the gross, it's pretty much all standard. You know, they get a raise, they get a promotion, we use the income right away. So that's important to know that a W-2 earner will usually go FHA conventional because they're already documented. Okay? But what if you have a W-2 earner that does not have 2 years employment, has been through a lot of gaps? You know, how do we finance those? There's a way to do it through non-QM. But what I want to stand out is most of the time, they're going to be self-employed borrowers, business owners, you know, house cleaners, painters, construction workers, or sales, or any other sales job they do. And they qualify using their bank statements. Most of them, if you talk to self-employed borrowers, you're going to see that they deposit their money on their business bank statement. Or let's say they use their personal account for business. You're going to see their high deposits. You're going to see they move money. But when you look at their tax returns, when you go see their filings, it doesn't match what they really make. So the non-QM will take, for example, bank statements instead of tax returns. Okay? And sometimes, rarely, you'll see a W-2 earner that has another side job, which will qualify with bank statements or even profit and loss, where he can use that income as well to qualify. So is non-QM really bending the rules to make things work? You can agree to say yes or no, or you can agree to disagree, because sometimes you'll think, well, if they're not checking your tax returns, that means they're not really checking. Hold on a second before you jump conclusions. They are checking. They're just checking another form of income. So if you have bank statements, if you have profit and loss income, like signed by your accountant, you're able to buy a house without filing your tax returns. And I get the questions all the time, like, Felipe, if we get a profit and loss from accountant A, he's buying a house with that profit and loss. Is the lender going to communicate with the IRS now? I get that question all the time. And I say to them, one thing has nothing to do with another. Okay? One thing has nothing to do, he's not going to communicate with the IRS. Okay? That has nothing to do. Obviously, if there's a foreclosure situation, someone doesn't pay, they investigate and call the accountant. Hey, does he really make that money? But the accountant is signing off on that. I've closed loans. Let me tell you guys something. I actually called the rep once and I said, hey, I got 12 bank statements and I have a profit and loss. What do you prefer? I swear to God, he said, send me the profit and loss. I don't want the bank statements. I don't want the bank statement. I want the profit and loss. So he'd rather believe what was written on paper, signed by his accountant, with the accountant's license instead of the bank statement. And that's how we closed that loan. And coming from, the investor standpoint, you'd be amazed. Why would he take it instead of bank statement? Bank statement, you're seeing a history, page by page, month by month. So we don't make up the guidelines, guys. We don't make up the rules. Oops, almost lost my mic here. Sorry. By the way, we are recording this, so we're going to have this all for you on YouTube. But that's how it is. I got a question here. What about the credit score for non-QM, and how much is a down payment for I-10? We're going to get into all that, okay? Good questions. I've actually got slides to show you, and we'll do some examples. So investors, high net worth borrowers, you got people making a lot of money, guys. How many business bank statements we look at, people are moving millions of dollars a year. But then you look at the tax returns, it doesn't show. So there's a lot of people out there that are qualified on rental income. For example, DSCR loans. If you guys haven't heard about the DSCR loans, you're missing out. You can buy a house without income, without profit and loss, without bank statements, just the rental income of the property. Obviously, it's an investor's loan. For example, you buy a house for income, you can use that rent to qualify. It's an amazing product. People are not aware. A lot of realtors are not using this product. How many deals have we saved with non-QM? How many deals? Okay, so here it is. Rather than using your personal income, foreign nationals, people that live outside the U.S., kind of goes a little bit with this immigration question here. Welcome, guys. Are you coming in? I'm allowing everybody in the room as we move. We already started. Again, this is recorded. You guys can see it after the full class from the beginning. So, can people outside the U.S. buy a house? Yes. Do you have to be legal in this country to buy a house? No. Unless a bill comes out, unless a law is approved where they can't. But as far as I know, the last 33 years I live in this country, immigrants have been buying this house, have been buying this market, have been buying houses in this market more than you ever imagine, especially the Orlando, Miami area. Okay? And I'm not just talking about Brazilians. I'm talking about different nationalities that are gaining power into the U.S. market. Okay? Are there laws that they have to pay taxes? Yeah. I had a client now in Florida. He doesn't have his papers. He was trying to sell a house. And the attorney said, hey, at closing, you got to pay your capital gain, 15%. Unless you have a green card or unless you have your U.S. citizenship, you got to make sure you pay your taxes. Trust me, the government's going to take their money. You're not going to see investors just come in here in the U.S., buy a home, and then get the profit and leave. It's not that easy as well. But there's no restrictions like, oh, you can't rent a home. We're going to take a home from you. None of that is formalized. So that kind of answers the immigration question there. You don't need a work permit. You don't need a social to buy a house, especially when you get into the foreign nationals. Buyers with assets abroad, but no U.S. credit. Not even credit. You don't have a credit score. Someone who lives in Brazil, they don't have a credit here. We don't pull credit. That's actually I wouldn't say the only one, but one of the only products that does not require a credit score. Every other non-QM product, most of them, 99%, they're going to ask for a credit score. You need to have a credit score to buy a house, right? That's one thing you need to have. So clients with credit events, bankruptcy, foreclosures, late payments, there's ways around that stuff. Okay. Obviously, we can dive in, and there's so much to talk about. Actually, let me read this little line here. Non-QM loans are creative financing option that helps more people buy homes when conventional lenders say no. So FHA and conventional guys are not the only products out there. USDA, VA loans are not the only products out there. There's many ways. You'd be surprised and amazed how many people are qualified. They don't know and you don't know. So let me make sure I'm allowing everybody in here. I don't want to miss anyone. Okay, looks like we're good for now. So real estate agents, non-QM means more of their clients can get approved. Okay, fewer deals fall apart due to financing issues. And we deal with a lot of different lenders. We have a lot of lenders we work. We actually signed up with a few new ones right now. Navigating through all these changes in the market. We're trying to keep up. Changes are happening every day, guys. Changes are happening every month. Okay, faster closings in some cases because lenders can be more flexible. Okay, bigger pipeline. You may look at a bar and say, "Oh, you didn't file the tax returns." Guess what? It's not going to keep them from buying a house. Okay, let's go. I wish there was a little comment. I wish we had more homes in the market. I wish we had more inventory. That's what I wish we did. So let's dive in. Talk a little bit about the profit and loss loans. People have been asking a lot about these loans here, these types of loans. Starting 15% down. Just that should blow your mind. 15% down. The bank will finance 85% of the property just with a profit and loss income. What is exactly that, Felipe? A signed piece of paper from the accountant with their license verifying they made that money. Okay? We do a lot of them here. Qualified based on P&L statements prepared by a CPA. Sometimes tax prepared. Does not have to be a CPA. Okay? Great for self-employed clients who write off too much on their taxes. Who is not guilty of writing off, expenses? Someone tells you, "Oh, I made $1 million," and then how much you take home? $50,000. It's like, I know you did it. It's not true, but it's what your papers say. So you're a non-QM client. Bank statement loans, 10% down. We qualified a client yesterday. She got denied by another lender. Came to us from a realtor, and trying to go conventional. Did their taxes high. I guess it wasn't high enough. Tried to go conventional. And then I looked over her credit score. Our team did a great job. Pulled the credit. Looked at all the financials. We'd asked for bank statements. And guess what? Her score qualifies her for 10% down. She had the money already sourced in her account. She's getting her pre-approval letter today or tomorrow. That's crazy. Qualifying using only 12 months. Even 24 months if they want to go back that far. You don't have to. I don't remember the last time I closed at 24 months. I only closed 12 months. But it goes person to person, scenario to scenario. No tax returns needed. Felipe, but wait a second. They're buying a house with 12 months bank statement, no taxes, nothing, no draft, nothing at all. No. All the lender's going to want a CPA letter to make sure he's self-employed or she's self-employed, and their bank statements tell all the story. By the way, it takes us 24 hours to upload all the 12 bank statements, runs into our software, and we get a fully calculated, stamped income by the underwriter. Amazing. Okay? Perfect for business owners, freelancers, 1099 earners, Uber drivers, painters, landscape people, all those. Starting at 20% down, the DSCR loans, debt service coverage ratio. It's an investor program for people that want to buy a house. I do these more in Florida. They want to buy a house for rental income. We use that property's income to qualify. No personal income, none of their business income is provided. Well, let's allow one more person in. Welcome, Fernanda, to our meeting. Again, this is being recorded, so you can watch from the beginning. Approval based on rental income covering the mortgage. As long as that rental gross, by the way, guys, here's a huge deal. You know how FHA hits with 75% of the gross rental? DSCR is 100% gross. If the mortgage is $1,000, the rent needs to be $1,000. Felipe, quick question. What if the rent's not $1,000 and the mortgage is $1,000? The borrower has to supplement the down payment to make sure that the mortgage is covered by the rent. Or we would have to do what's called a rate buy down to bring the payment down. Okay? Talking about rates, you guys been hearing it. Rates are moving towards a positive direction. Hopefully it's going to go down. It's going to bring a lot of good stuff to the market, more buyers, more movement. That's what we need, right? Maybe more people listing their homes, selling and buying. So anyways, DSCR loans, they're based on the rental. So what's the most important thing or important document that we have to have with DSCR loans? We need to have an appraisal that will document that rental income, okay, or rent schedule to make sure we have those numbers. So we need the appraised value, obviously, and we need the rental income, and then we'll know about DSCR. Sometimes it will go down to 25%, go up to 25% down. Sometimes they'll even do 15% down. I haven't done a 15 yet, but I've done a 20% down, okay? But here's the thing about DSCRs. We learned very hard in a very hard way. If you do not own a home in the U.S. and you're trying to buy your first home using the DSCR program, they're going to request at least 30% down. I tried many lenders. We actually worked with a lot of different investors on this program, and they all say the same thing. Why? Why are people required 30% down when they don't own a home? It's because it avoids people using this program for an owner-occupied. So whenever you think about DSCR, it's got to be for investment purposes only. And you can use it with 20% down if you own a home here. If you don't own a home in the U.S., you own a home outside of U.S., maybe in another country, there's some guidelines they'll bend for 25% down, but we really have to document that. We actually did one last week, 25% down. He owned a home in Bolivia, so we were able to prove that. But man, was it hard. It was a tough one. And that's the one that we closed real quick when we had it transferred. But anyways, keep in mind, if you're a first-time buyer, it's 30% down. But if you're not a first-time buyer, you already own your home, 20% down. Now, why is this information also a benefit to us, you real estate agents and me as a loan officer? Because what happens is it kind of pushes you and the client to get their first property. Why would you invest in real estate and not have your own property? Why would you pay rent and invest in real estate? So it's a question you have to ask. You have to ask yourself. You have to ask your borrowers. Say, hey, it doesn't make any sense. Own your first home first, okay? Buy your first property, live in that, then go invest. That's kind of where the model is designed at its best. But this is where, guidelines are studied and designed so that people don't take advantage of the market, okay? Approval based on rental income. I said that. No personal income deducts used. Ideal for real estate investors. I know people that have 30 DSCR loans, and usually they buy like with LLCs. I've heard people that have, 10, 20, 30 loans, DSCR loans, and the property's all paying for it. That property is just generating income, okay? So starting with 20% down. Very interesting program. Very fast to do as well, okay? Creative financing options. A quick list here. We're going to break this down, by the way. I have an Excel here. I'm going to go over with you, and I'll be done, guys, in 20 minutes. I'm going to go through this so I don't take a lot of your time, but I want to make sure you guys understand the power of non-QM. Bank statement, 1099 programs have self-employed buyers qualify without tradition. We know that. The I-10 loans. So if a client has a 19 loan, not a social, you can still buy a house 15% down, okay? Serve immigrant and underserved buyers with flexible documentation requirements. There you go. Your new pipeline's been unlocked just with that one. 2-to-1, 3-to-1, buy downs. A lot of people are doing now ARM rates. Instead of fixed rate, get an adjustable rate so they can get a rate lower. If the monthly payment is a problem, this is a good program to use. Reduce the initial payments to ease rate anxiety and create urgency. We did a loan last month for a client. We saved her $500 a month. It was a property she bought for rental income, so she wanted a cash flow. This was a perfect program where she got more money now in her pocket because the mortgage payment is less instead of her paying the fixed rate. And here's another tip. You guys can tell your buyers this. Adjustables or adjusting rates, whatever, fluctuating rates, programs, they're not as dangerous as you think if you know how to take advantage of them. So let's say that on a fixed rate, you're going to pay $2,000 in mortgage, but on an adjustable or buy down rate, you'll pay $1,500. Oh, Felipe, but it's interest only. Okay, on a $2,000, I'm paying a little bit of principal and interest. But guess what? You can just take that $500 extra that you were going to pay in your regular fixed rate and just put it towards your principal. So you pay your $1,500 interest only, and you pay the remaining towards your principal. So it's still a very good program, especially now the rates are like all over the place. DSCR loans, we just spoke about them. HELOCs, okay? How many HELOCs have we been doing now? Okay, I can't move until I sell kind of situation. I can buy now, but I need the money. HELOCs, we do those. Okay, I can definitely get into more HELOCs with you guys on that. Before we go into Q&As, let me just open up this Excel here that I want to show you. Let me see if I can just, there it is. All right, I want to kind of show you guys, I know the screen is sharing it. I'm also, I'm also recording, but I want to show you guys kind of a comparison with all the programs side by side. So let's say the blue programs, cidadão pode utilizar no QM and how much? Yes, you can. You can use, citizens can use non-QMs, immigrants. Yep, no problem at all. Everything I spoke about applies for both. On the blue products, let's say these are the conventional stuff. FHA, VA loans, as you can see. I think most of you already know about this. Pretty standard, right? And I can send you a copy of this so you guys can see it. On non-QM loans, I'm kind of breaking down for you guys here the DTIs, single family up to 4 units. DSCRs you can do to 8 units. So that's a good thing to know. So non-QM, it can be either owner-occupied or it can be investor. DSCR loans, okay, we talked about that. Covering the ratio, 50% DTI, a single family or 4 unit. The one we just did was a 4 unit. Investor program, so you can't use that for unoccupied. Profit and loss loan, 20% down. Okay, the accountant signs with his license numbers. I mentioned that to you guys. Sometimes we'll request our own PDF template, and the accountant will sign that, or they produce their own template. Okay, and it can be used for investment or unoccupied. Hard money loans. Oh man, how many have we done with those now? Properties that are not, passing appraisal, properties that are needing to be fixed. They call it fix and flip, right? They want to sell it after, or they want to fix it and then rent it out. Hard money loans will get into those tough situations where, non-QM loans or conventional loans won't get into. So very good use you can make of hard money loans, especially if you're working with investors. Okay, if you're working with investors, you can definitely use these type of loans. Especially, I had one yesterday. Let's welcome Silvana. Hi, Silvana. Welcome to our class. So basically, investors. I had one yesterday. He came up with me. He's a W-2 earner, American citizen. I told him about the FHA program. He's also a builder. He works for a company, and that's what he does, construction. And his income with the W-2 was not really qualifying for what he needed. The buying power was just not there. So he presented me a situation. He's like, what if I buy this property here? That's kind of needs a lot of work. It's very cheap, but I have to fix it. I'll fix it, and then I'll refinance later. We've done those a few times, and these programs with the hard money loans, they work very well because you basically help them get the house with like 15, 20% down. Usually they're 20% down. You get the house. The lender will give 100% financing for the construction. The client will do whatever he needs to do with the house. And then when it's ready, we'll refinance 6 months or 1 year down the road. We'll refinance the house so that he keeps it. Or in some cases, or most cases, they will sell the house and just make a profit out of it and keep doing that. I've done flips myself. It's a lot of work, but it's worth it. It'll pay off. It's just finding the right deal is kind of the challenge today. But I've done flips where I lived in a property. I fixed that up. I sold it. I got the profit, bought another property, fixed that up, sold it. So there's ways you can do that to take advantage of the hard money loans, especially in the situations where foreclosures, properties that don't pass appraisal. So no DTI obviously on that. They do a little light credit check just to make sure the person doesn't owe a lot of stuff. We spoke a little bit about the foreign loans. Usually they're between 25 to 30% down. Someone can buy a house, for example, in Brazil, buy a house here. We'll translate all the documents, all that stuff. Obviously an investor program, right? Rates. I threw these out here. Obviously they're changing here and there. We have done profit and loss loans with 775. We have done DSCRs with 625. Or in this case, actually rounded off for me, but let me just go back down. Yeah. So we've done rates are going to depend on credit score. Rates are going to depend on down payment. Okay. When you guys have a question about rates, it's always going to be determined by how much down payment or loan to value is going to be lended and how much is their credit score. That's the two things that really will tell you the rate, will structure the rate for a loan. DSCR loans, like I said, profit and loss loans, we've done it with 7.5 as well. You know, rates are adjusting, guys. It's a good time now to think about this. Hard money loans, I have a lender now that's doing 9.99% a year. And guess what? They're about to drop it as well as rates are adjusting. Hopefully it will go very low. I don't know about this year going too low, but it'll be adjusted to maybe some normal ranges, maybe enough to move the market a little more. Foreign loans, 8.25. I can go all day here, but again, as you guys know, it's going to depend on credit pull, down payment, all that kind of stuff. So Felipe, reserves. If someone's buying from Brazil, this is a huge one, guys. How many reserves do they need? What is reserves, first of all? Reserves are, if you're having a mortgage payment that month, the reserves will be that payment times whatever months of reserves they want. So if it's let's say the mortgage payment is $3,000 a month, and they want 3 months reserve, that's $9,000 they want to see. Does the lender take that reserve and keep it? No. They just want to see it on the investor's account or the buyer's account that they have a way to pay the mortgage if their tenant doesn't pay. So the more tricky, the more risky the loan gets, more reserves will be required. The normal is between 3 to 6. So for example, the foreign loan are the ones they ask for more because that's a very, very high risk loan. The person's living in another country, you know, is not always going to be in US. Is someone managing the property? So there's questions that are asked and they measure that by adding reserves. So it's not always the case. It can be less. But trade lines, no trade lines, just a CPA letter from the country where they live, reside, work, and we'll just translate that. 1 month bank statement, sometimes 2, just to prove they have the money in the account. So who's ever buying foreign loans, they're just going to buy with money down. Hard money loans, like I said, no credit check. Profit loans, trade lines. Yeah, they'll ask for like two or more trade lines. Alternative trade lines are also being used for, like, you know, if you pay rent, if you pay an utility bill, a phone bill, that's an alternative trade line if it's on your credit report. Reserves for profit and loss loans, usually 3 to 6 months. We usually do them with 3 months, okay? Gifts are allowed, depending if it's an owner occupied. AUS approval, nope, no such thing as an AUS approval. By the way, you're going to see that on the orange programs here because conventional, FHA, VA, USDA, all those loans will ask for a AUS approval. It's an automated underwriting system. These loans do not do that. It's manual underwriting directly with the underwriter. So no AUS on these. Up to, we actually been up now to $10 million. We can do $10 million loans. But usually they'll cap around 2 to 3 million. As you know, loan limits with FHA conventional, you're going to have the FHA loan limits, all that kind of stuff. We can definitely get into that if you have questions. What else is interesting here? Okay, let me just jump into the doc list a little bit, okay? That way you can see. I can send you guys all this. Usually when I'm qualifying a client, obviously I'll ask the right questions. I'll find out what they want to do, if they're an investor, if they're buying to live, and then we'll see what program they'll qualify, and then we'll see which docs we're going to initially request. So obviously if they're FHA, we're going to request, you know, tax returns, W-2s, all that stuff. If they're non-QM, as it's what we're talking about, we'll ask for 12-month bank statements. We'll pull their credit. The difference with non-QM credit scores, by the way, if you have a 660 score, your minimum down is 20%. But if you have a 680 score, your minimum down is 15%. So 680 above, 15% down. So that's interesting to know. Okay, we do have a credit specialist, Arthur. So if someone needs to work on their credit, if that's what's keeping you up from financing, we have solutions for that. We can work on the person's credit to make sure to see what's going on and fix what's going on. Like I said, income takes about 24 hours to calculate, all that kind of stuff. We can do with the DSCRs, obviously appraisal. As I said, we'll have to make sure the appraisal documents the value and the rental income. Profit and loss income, we'll ask for the accountant's contact because we'll deal with the accountant, make sure we get all the forms we need. But the borrower can get involved if they wish to. We just make sure we get the right letters, we get the right profit and loss statement, and we'll have sample letters available as well where they can get to their accountant to make sure it's done. A lot of accountants, you'd be surprised that I speak to, they're not even aware that these programs exist. And so they end up calling us and finding out, but we definitely guide and help them to make sure people are getting the right information. Hard money loan, usually it's going to be the down payment and the credit pull. Foreign loans, CPA letter from Brazil, just to verify they work in Brazil. No score needed, bank statements from Brazil. We'll translate that. We have done it a lot here. If they choose to do an LLC, we'll help them get it open here and buy the property in LLC. Now, I do have simulations we can go through all day here. We can, price out any house you have. Usually we do this with the initial conversation when someone say, "Hey, I'm trying to buy a house for $700,000. How much would be my interest rate if I do a non-QM bank statement loan? I'm putting 15% down. I have a 680 score or above. Real estate, taxes, insurance, okay, all that included. We'll design a scenario specifically for the property you're trying to buy. So you as a real estate agent, before you drive to the property, show it, to the client. We'll run simulations and loan scenarios so you have a rough idea if that makes sense. If that client is buying a $700,000 home with 15% down, how much are they spending? How much are their closing costs? Okay, how much are their reserves? So things like that, like how much of their monthly payment is very important before you start going into properties. So we do that. Once we qualify your borrower, we qualify your client, we then work with them to make sure that you and him or her know exactly where you're going. By the way, we're able to find for investors now a little less closing costs. So if you're trying to buy a house for an investment, you can actually benefit from a less closing cost. Non-QM closing costs are higher than FHA conventional. Again, more risky loan, more risky features, more money they're going to pay. So sometimes the comparison I'll get between a conventional, okay, let's say a conventional here. Let's put 700,000 real quick. Let's say this is an investment property, 15% down, conventional. Let's use the same rate, okay? Same taxes. Let's say the insurance is $2,000, $4,500. Let's go to non-QM. Do the same thing here. I'm just going to compare for you guys real quick so you can see. Same rate. I got the mortgage insurance here. Would be less than that because they're putting more money down. So like conventional will have PMI where non-QM does not have it. Even at 15% down, there's no PMI. So this house at $700,000, he's spending $105 to buy it. Okay, $4,600 monthly payment versus $4,674 in conventional. But here you have to prove tax returns. Here you don't have to prove. Okay, so you can see the difference is very minimal. Now, closing costs is where's the big factor. Here, with conventional, you're going to spend about 3.5% of closing costs. In this case, it's 3.4. Okay, with non-QM, usually it's going to be like 5% closing costs or higher. And that's where people end up spending. So even if I remove the reserves out of these right here, at conventional, he's spending 129, and non-QM, he's spending 142. But look at the benefit. This is something huge. 142,000, right? Let's see that 142,000 minus 129. So let's say he's spending $13,000 more on a non-QM product. But guess what? He's not paying taxes as if he were to pay in conventional. So instead of paying the IRS $40,000, $50,000 taxes, he'd rather do non-QM, save money with the IRS, spend a little more with the closing costs, but avoid paying the IRS. So people choose those routes sometimes. That's why non-QM is so powerful. When you have basically almost the same rate and you have the same down payment, why not? Oh, Felipe, what if this was an owner-occupied? 5% down, tax returns, and all that. Okay. A little higher rate, right? Because you're putting a little less down. Okay, more monthly mortgage payment. That's good. But maybe they want a less mortgage payment. So there's things we balance. There's things we calculate with the clients. Like, which route do you want to go? What is easier for you? So those are the things that we look into individually. Do you mean sharing the spreadsheet? Let's validate. Yeah, I can share it. Yeah, we can share the spreadsheet. That's fine. Okay, let me open up some questions now. You can open up your mic and shoot some questions over if you have any. With a little bit of Q&As. I want to hear from you guys. Anything you're working on, anything that came to mind as I was speaking that something you can convert. Okay. I'll also leave my contact information here. I'll telephone number, email, our website. So if you guys have any questions, I know that maybe a lot of clients come to mind a lot of opportunities start opening up, right? When you see all the ways to finance clients. Let me jump in here. Let me talk about a little bit about a deal we're working with Silvana right now. There's actually a client that sold the property and is using the 1031 exchange to buy two more properties. We closed on the first one. We're now working on closing the second one. The second property had some issues with the house they're fixing, but it was a non-QM product. The client came to me. The tax returns were not qualifying. He could not do it through the tax returns, so he said, "Hey, let's get through the non-QM." Got a great rate. Closed already on the first one. He's about to close on the second one pretty soon. But I could think of so many products right now or so many examples and clients right now that I could put on paper and say to you how many deals that these loans have saved. And not just save the deal, but save the client thousands and thousands of dollars. Okay? So imagine the situation with Silvana's client. Let's say that he had to go back, file his returns, get all that paperwork done with the tax accountant, with the IRS, which you guys know takes so long, and then to come back to us to qualify, he would have already lost his 1031 exchange. If you guys don't know what a 1031 exchange, that's when I'll just kind of basically go over here with you. It's when you can benefit on saving, investing your income and saving to pay capital gain to the government. So you're moving money from this sale to this purchase quick enough within their term times so that you avoid paying taxes on your profit, the profit you made as an investor. Keep in mind, your owner-occupied property, you don't pay taxes on the proceeds unless I think it goes over $500,000 per couple or $250 per person. But anyways, that's another story for another day. These programs are fit to go fast and qualify the client a lot quicker than a conventional. Okay. For example, if you're getting a conventional client now, you're basically getting tax returns, IRS agreement if they owe money to the IRS, or you got to prove they paid, proof of filing, all that kind of stuff is going to happen before you can close because underwriters request that. With non-QM, you're avoiding all those steps and you're basically providing what's needed and getting done. One important thing I'll mention to you guys, when someone is qualifying for a non-QM product, usually the underwriters will ask on how are their rent payments. So one question that I ask every time I meet a new client is that how do you pay rent? Do you pay it by Zelle, which most of them do? Do you pay it by check or do you pay it by cash? Depending how they do it, we're going to have to document that. So if you have a client who's renting right now and needs to document how they rent, it's very important to find out how to do it. We'll do it through a VOR as well, which is a verification of rent with their landlord. Another thing I can think of, cash deposits. You see a lot of people, that kind of stuff, like, oh, I have the money. How do I put in the account? You have to document the right way. So there's a lot of different things you have to look at that we look at, and so much you keep learning with non-QM, and it keeps growing too. All right, any questions? Let me see. Can you do a CLOC? Let's see what a CLOC is. I think that's the first time. Did you meant to say HELOC, or you purposely said CLOC? Let me see what that is. Actually, so commercial. Okay, commercial. Yes, we have commercial loans. We don't offer it directly, but we can connect you with someone that can do a commercial line of credit, a commercial loan. I have done a few commercial loans. Matter of fact, I did a few SBA loans. I did one that was 100% financing. The client bought it's a granite shop. He bought a granite, his own building, 100% financing. All he paid out of pocket was closing costs, and we financed it through SBA. We do have some nice programs for commercial. Even that's a shop, so that's his own occupied. But if you're looking at like a residential commercial, like 10 units, 20 units, 15 units, we can do that. Obviously, it wouldn't be through SBA because SBA is focused more on the business owner, not an investor standpoint. They're looking more toward your owner occupied building. But we can do commercials. Yes, we have ways to do commercials. We do churches as well. But it's funny. It's the first time I see that CLOC. I guess the whole different is not a home equity. It's a commercial equity line of credit. Yep, we can connect you with the right people. We basically do everything here, guys. Everything. I was once an FHA conventional loan officer, and that's all I did all my life. And then I quickly learned that the market is changing. People's realities are changing. One day you're selling their house. you're selling a house to them. Another day you're selling their shop, and another day you're selling their investment property, and then they're buying their vacation property in Florida. So we quickly learned not just to expand our products, but expand our states. We are licensed now in 9 states. Basically, let me correct that. We can do 50 states as long as it's DSCR programs, anything like that. We can do 50 states. And as far as owner occupied, we'll do 9 states, and that includes Massachusetts, New Hampshire, Connecticut, Rhode Island. We also do Pennsylvania. We also do South Carolina, Florida, Texas, and what else? Washington, if I didn't forget any. So 9 states. We're expanding as it goes. So we quickly learned that we have to expand our products and the states we do. Okay. Will this be translated to Portuguese, or if it needed? Yes, we can translate all this stuff to Portuguese. But most of the products with our real estate agents, Jennifer, will be in English because it's just easier. But yes, we can definitely translate it for you. That's why we have ChatGPT AI, right? Missouri. Olha, guess what? I got a notification on Missouri. They did email me yesterday. I'm in good standing, but my license is not active yet for owner occupied. But I can do DSCRs, investors loans there for you. But soon enough, I will be in Missouri. North Carolina, not yet. North Carolina, I'll tell you the reason why. I applied, it's pending. They asked me to have a physical office at the state. That's actually one of the, I think it's only one state. No, Missouri actually asked for it too. Or was it Arizona? Now I'm confused. I know North Carolina was one of them that said, you need a physical office here. So I'd have to go out there, have a physical office. And obviously that would need more network in North Carolina. And then I'd be able to do that. But listen, let's build a network. You got people down there. You got buyers. Why not? Is it, Will? Is Missouri an amazing state? I've never been. I want to go out there. Especially when I go, I want to go close a deal. Yeah. Yeah. Tá bom, Márcia. I didn't forget about you. Vamos conectar. Absolutely. We got to do a lot of networking investors. Guys, any more questions? I don't want to keep you guys too long. I promise you I'll end at 12. Marcia, I'm serious. We got to connect. You're probably my bridge to connection there to close some deals. Yes, ma'am. So 12 o'clock, we're going to be ending right now. I do want to grab any questions you guys have. Any questions you guys want to ask now. I'm also available here to connect. Our team is available to connect. If you have a deal you want to work with, if you have a client we got to call together. Before this training, I was actually with my team notifying everybody, get ready. You know, real estate agents are going to need our help. We're going to have to move quick to make sure we help them convert deals. So we're here to help you. I know everybody has a different scenario, different client, different background. You just be amazed if you run it by us and see the options that are available and the opportunities you can create. You know, let's end this by saying there's so much people out there with equity, value in their home that need to cash out and invest in properties, even invest in their own home, you know, pay down debts or buy other properties. So there's so many things you can move. And I get this all the time from people that are moving out of state too. They're coming to Massachusetts or they're going to another state. They want to sell a house or want to cash out. And people ask me all the time, Felipe, can I buy as a first-time buyer again? If I'm moving to Florida, for example, if I'm moving to South Carolina, can I buy a property using your first-time buyer program? Yes, you can. Every time you're going to occupy a house, guys, it's totally different than if you're buying to invest. But anyways, a lot of good stuff. Thanks, Gisele. I hope you had a good time here in our class. I try to be very quick, guys, very objective. I know everybody's busy. I know everybody's selling. But anyways, if you guys have questions, have a specific scenario, contact us today, anytime this week. We will make sure we get with you and your client to make it happen. Again, thank you. I want to thank all my team for putting together the presentation. Everybody that's been working so hard. It's such a tough market, but stay positive. And guys, there's a lot of deals to close out there. You can count on us. Yes, we do. Já temos data para a próxima. Yes, we have. Thais, what was the date? I think it was September 18th. Thank you, Fernanda. Appreciate you coming by. Thais, we'll send out a poster to you guys. Guess what? We're going to be doing this every month, guys. Every month, I'm going to do this masterclass. If we grow it, that we need to do 2 a month, I'll do 2 a month. I'm here to help you. I'm here to make sure we close your deals. Okay? Thank you, everyone. Take care. Have a great day.